Howdy, Jacob here. Today we're looking at Northwestern Corporation, ticker symbol NWE. $3.1 billion market cap, $5.7 billion enterprise value, a lot of debt in the multi-utilities industry. I have a feeling we've seen companies like this before, but let's look at dividend first. 5% yield looks pretty great from that perspective. $1 billion in debt in 2012 to $2.5 billion in debt 2022. Cash and cash equivalents of less than 10 million, essentially nothing. So they have no liquidity in case their lenders start asking for their money back. Let's see what that is in relation to free cash flow. All right, another quick video. So here's why it's a very likely no for me. We see that their 5-year average free cash flow is negative, and yet they've been paying out $150 million in dividends, and they've been increasing it from $58 million back in 2013. To fund something that you don't have free cash flow for, you need to either issue shares or issue debt. And you can see from their cash flow statement, they've actually been doing both. So 2014, they issued $398 million in stock, $633 million in debt to fund their acquisition as well as fund the dividend. As you keep going, even when there's no acquisitions, they still use some combination of issuing stock and issuing debt to fund the dividend that they cannot afford, because you pay out a dividend through your free cash flow, not through earnings. And so you can see that the business has been growing. It looks great, or it looks solid, 1.15 billion in revenue to 1.5 billion in revenue in 2022 over a 10-year period. Not bad growth there. But due to their growth, their capital expenditures are far outreaching the cash from operations that they're producing, which produces free cash flow negative. And again, meaning if you pay out a dividend as big as what they're doing, a 5% yield, $140 million payout, they have to issue shares or issue debt or some combination of the both to fund this project. And so these assumptions are going to be pretty wishy-washy. I'll say divide by 10. It doesn't really matter. They can't afford it. Say 3% revenue growth. They'll probably grow relatively in line with inflation. 12%, 3%, 2%, 13, 15. Okay, so looks really ugly, but again, these types of companies that don't produce cash flow, they just can't fund anything. And so you have to go into debt or issue shares or some combination of the both to fund these projects or to fund paying out a dividend that looks fantastic to shareholders that just don't know any better. Don't be that individual. Be the person that knows better and says, wow, a 5% dividend sounds fantastic, but can they afford it? No, they cannot. They don't produce free cash flow, so their payout ratio doesn't exist. There's no free cash flow for them to pay out, and so they're going into debt and issuing shares to fund that, which is the longevity of that will be cut short, especially in a high interest rate or what could possibly be a high interest rate environment for the future. And you can't just keep issuing debt, keep issuing debt. Lenders are going to come at your door and say, hey, we need our money back. You're not giving us the money that you promised you give us back. And that would force them to liquidate all their assets and the company would go under. And so that's not a company I want to invest in at all. And definitely not one that I'm looking to invest in for a dividend yield of 5% that they just can't afford it. And so for me, it's a pretty quick, I'm not interested. Although I say every business has a value to it, I'm not saying this one doesn't, but I can tell you it's definitely not at the current price that it's at right now. I'd probably be looking for, I mean, if we're talking price to book, maybe 0.5, because you'd have to really look into their property, plant, and equipment, see what they could sell it out for. Are they selling it for 50 cents on the dollar? Are they selling it for 80 cents on the dollar? Then it gets to a bit more in the specifics. But right now, as per the normal free cash flow estimate that I do, an earnings estimate, it just doesn't make any sense to me. So sorry for the quick video, but I also like doing these videos because it helps people understand the type of businesses that should be just quick dictionaries on the dictionaries. You don't want to be looking further into. You don't want to waste your time. There's too many companies out there to be wasting on your time on companies that just don't make sense to you or me or anybody. If you're doing the evaluation and it doesn't make sense to you, then don't look any farther. So to me, I'm just explaining why this doesn't make any sense. They don't produce free cash flow, so the dividend doesn't make sense to me. Even from a business perspective, the more you grow, the more you have capital expenditures. And if your capital expenditures exceed your cash from operations, you're not producing true business, um, my type of business of free cash flow. Um, and free cash flow is the lifeblood of a business. So that's just that. Sorry for the little rant, I guess. Nothing too long, but um, it just frustrates me the type of companies that have these beautiful yields and just kind of in a back way just kind of trick investors. But please don't be that person. Understand the business. If it doesn't make sense, cross it off. So I hope everyone enjoyed it and has a great rest of their day.